Hi friends, my name is Ashish and this video series is for 11th Commerce, subject bookkeeping. And the chapter that we will be dealing in these videos is Introduction of Bookkeeping and Accounting. Now, before starting the chapter, I would like to congratulate all those students who have cleared their 10th and are entering their college life in the field of commerce. Now, there is one thing I would like to congratulate you on is that you have chosen an excellent field which is filled with opportunities and there is absolutely nothing for you to worry. A piece of advice will be just focus on your studies, make friends, enjoy your college life, and you will have an excellent career. Let's get started with the chapter Introduction of Bookkeeping and Accounting. Now, this chapter is basically divided into three parts. The first is bookkeeping, which will give you meaning, definition, features, objectives, importance, and what are the utilities of bookkeeping. The second part is accounting, which will give you the same thing, that is meaning of accounting, definition, what are the features, what are the various branches of accounting, and then what is the difference between bookkeeping and accounting itself. And the third part of the chapter is basic accounting terms and concepts, which will give, as the name suggests, explain you basic terms and concepts of accounting. Now, in the textbook, the chapter goes like this. First, they will give you what is bookkeeping, then accounting, and then what are the basic terms and concepts of accounting. Now, for the sake of simplicity and to make you understand better, we will be first starting with basic accounting terms and concepts. So let us get started with basic accounting terms and concepts. The first and the foremost term which you need to understand is what is a business transaction. Business transaction. Now, here is an example of the most basic business transaction, the most primary business transaction, that is buying and selling of goods. So, A Limited who manufacture papers and there's B Limited who manufacture soaps. Now, A Limited is selling papers to B Limited. Why? Maybe for packaging material, or maybe B Limited is selling soap paper, so it requires papers. Whatever it is. So A Limited is selling paper to B Limited and he's selling them for 20,000 rupees. Okay? And on the other hand, we can also say that B Limited is buying papers from A Limited for 20,000 rupees, right? So, business transaction is basically buying and selling of goods. Okay, so business transaction is buying and selling of goods for exchange of value. Here the value is 20,000 rupees, right? Now, for A Limited the value is 20,000 rupees and for B Limited value is papers. So there is an exchange of value and which can be measured in money, right? So we can measure this whole transaction in money, that is 20,000 rupees, and which affects the financial position. Now, by affect the financial position, I mean A Limited gets 20,000 rupees extra in cash, which affected its financial position, and B Limited is getting papers, which has affected its closing stock, so its financial position. So to sum it up, business transaction is basically buying and selling of goods in exchange of value, which can be measured in terms of money. Simple as that. So now in business transaction, there are two types of business transaction. First is monetary transaction and second is non-monetary transaction. Now, monetary transaction, as the name suggests, any transaction which involve exchange of money or money's worth is a monetary transaction. Like this transaction for example, where there is an exchange of 20,000 rupees, which is money, and paper, which is money's worth. So what will be non-monetary transaction? Any transaction which does not involve exchange of money or money's worth is a non-monetary transaction. Now, the main thing to understand here is that monetary transactions are recorded and non-monetary transactions are not recorded. The reason being, since there is no exchange of money or money's worth, there is no need to record monetary transaction. Simple as that, which basically means that any transaction in the business which involves exchange of money or money's worth will be recorded, and any transaction which does not involve exchange of money or money's worth will be non-monetary transaction and hence will not be recorded. Now, in monetary transaction as well, there are two types of transaction. First is cash transaction and second is credit transaction. Now, as the name suggests, cash transaction. So let us take an example itself. This example, for example, this is an cash transaction because there is an immediate exchange of money, or the money is exchanged on the spot, right? A Limited sold paper, B Limited gave 20,000 rupees. Now, let's say if A Limited supplied paper to B Limited, but B Limited promised to pay 20,000 rupees after 2 months, right? In that case, what has happened that the payment of cash or the payment of money is postponed to future date, right? So that is credit transaction. See, here we have the definition. Cash transaction is where the payment of cash is done immediately and on the spot. And credit transaction is where payment or receipt of cash is postponed to a future date. That is, it is not made on the spot. So, after business transaction, we have entry. Now, entry, as the name suggests, is the first record of any business transaction. Basically, whenever you have any business transaction, when the first time it is recorded in the books of account, it is called an entry, and such an recording is done in a proper form or method. You will understand what is entry and narration in more detail in the further chapter called as journal entries. But to give a definition of it, entry is the first record of any business transaction, and such a record is done in proper form or method, and such an entry is made in books of accounts. Simple as that. After that come narration. Now, narration is brief explanation of any business transaction for which an entry is passed. So, to record the business transaction, we make an entry, and to understand for what that entry is made and for which business transaction is made, and to provide more details of that entry, we give narration. Again, this will be understood in detail in the further chapter called as journal entries. After that, and other thing is that narration starts with the word being. This too you will understand in journal entries as well. After narration comes goods. Goods is basically any article, commodity in which the trader deals. For example, computer. For computer dealer, computers is the goods. For bookseller, books is the goods. And in for A Limited, who was manufacturing paper, paper was the goods. So basically, goods are any article in which the trader or the business deals in. Now comes another important concept, which is profit and loss. Now you understand generally what is profit and loss, right? We will try to understand it in more technical terms. Now we will take the earlier example itself, where A Limited sold papers to B Limited for 20,000 rupees. Now let us assume a situation in which A Limited manufactured them for 15,000 rupees. So he sold them for 20,000. His manufacturing expenses were 15,000. So obviously his profit is 5,000. So can we say that profit is nothing but excess of your income over your expenses? Now we'll come to another situation where instead of manufacturing for 15,000, it took A Limited 25,000 to manufacture the same papers, right? So he sold them for 20,000, but manufacturing expenses were 25,000. So here his loss is 5,000 rupees. So the definition of loss is very simple. Loss is excess of expense over income, right? So understand the difference here. In case of profit, your income is higher than your expenses, and in case of loss, your expenses are higher than your income. So that is how the definition changed. So in case of profit, the definition will be excess of income over expenses, and in case of loss, the definition will be excess of expenses over income. Now we will try to understand what is the difference between your profit and income. So as the name suggests, income basically means anything that comes into your business, or any amount that comes into your business as a result of business transaction is your income. And then what is profit? So basically any amount received over cost is your profit. So the formula for profit will be sales, that is sales price, that is sales, minus cost price, that is your cost, will be your profit. And the definition of income is any amount received as a result of business transaction is your income.